Hey everyone, welcome back to the channel. We're going to take a look at Etsy in the coming days. So this is the first video to kick that off, and we're going to start by calculating their WACC. This is what I usually do. And then the next one we'll probably have a video projecting their revenue, and then we'll probably just do a DCF pulling it together. I don't think we'll need one on their margin profile. Maybe we will, but I'm guessing it's pretty straightforward. So let's get into things and let's look at how we calculate WACC here. First, we need market value of equity, 21 billion. We just pull that off of Yahoo Finance. Market value of debt, this is coming from page 135 of their 10K. So if you come to their 10K, which you can pull up on the SEC website, you're going to go down to page 135 and you'll see they have 2020, 19, and 18 notes. You can see the original principal balance and then the net carrying value for a total of 1.64 billion. I've copied that over onto a debt schedule. And then they provide us the interest rate. Actually, if you read the note here, effective interest rate, 3.5, 4, and 4.75. So we have all that info, so we can get the cost of debt, about 3.79% on 1.1 billion. So we'll plug that in. Cost of equity, this is always a fun one. And I'm going to talk a little bit more about this in this one. So we use CAPM to calculate it. We need the treasury yield. This is straightforward, just comes from the treasury website. The expected return on the market, 8% is just kind of the standard assumption for the S&P 500. There's a link for where that comes from. And then beta, this we calculate. So if we look at our beta, you're going to want the monthly closing price for the last 5 years. So you'll go historical data on Yahoo Finance, 5-year monthly. Hit apply. There you go. Download. You'll put the adjusted close price in here. The template does everything else for you. And so for Etsy, I've actually, I was looking at their stock chart and I thought it was interesting. I was like, okay, they didn't really do much until like mid 2018. So like years 5 and 4, like 5 years ago and 4 years ago, right? Or however we think about that, nothing really happened from 16, 17, 17 to 18. And then it kind of started to take off. And then just a huge spike in the last couple of years. So their beta for 5 years can be fundamentally flawed. You'll see here they have a 1.53 beta based off Yahoo Finance. And when we calculate the beta for 5-year, we get 1.49. We're right there with them. Now, if we tweak this and we calculate a 3-year beta, you actually get a beta of 1.99, which is, what is that? 33% more than the 5-year. So in recent years, they've experienced much more volatility or much, heightened returns in comparison to the broader market. So it is a little bit of a riskier play there. So they've been much more volatile than the overall market. So if we look at the 5-year, right, using the 5-year beta, you get a cost of equity of 10.8%. Throw that into WACC, you get a 10.4% total cost of capital. To me, that's a pretty conservative, that's like a neutral company. I'd use that on something like, I don't know, something with a little bit of risk, but nothing crazy, like maybe like a Facebook, something that's growing, but it isn't anything super crazy, is probably to me about a 10% WACC. Now, if we use the 3%, you get a 13.5% cost of equity and a WACC of 13.1. And I think that this is probably a little bit of a more appropriate cost of capital to use. I think they've experienced tremendous growth. They've benefited tremendously from COVID. And I think to ignore that tremendous growth from a discount perspective would be flawed. I think inherently there's a lot of risk in this business going forward, just from the aspect of can they maintain, these levels of sales and cash flows. And I haven't looked at their financials too much yet. When we dig into it, we're going to try to forecast out revenue. And, if we're using 2020 as a base, right, they probably had pretty high sales due to COVID. And the question is that going to continue? And if we think it's going to continue, then for sure we need to be using a high WACC because there's some risk there that's not captured in the lower WACC. That's bringing in a lot of the historical returns it had when it was a pretty slow-growing neutral company. So anyways, I think this will be a fun one to look at. Had a lot of people ask about it. Had one individual as well send me a model they pulled together and just look at it. I actually thought it was pretty interesting, and I think it's similar to kind of the Amazon, Alibaba, when you look at kind of the GMV on the platform. I think obviously they have a lot more ancillary businesses with cloud and stuff, but I think Etsy, the core business there is an interesting thing to take a look at. So we'll go ahead and do that. So thanks for tuning in. Let me know if you have any questions or comments, and I'll get back to you. Thanks so much.